This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, as you'll see now on the title to Chapter 7, we deal with tax-adjusted trading losses. Here, of course, we're dealing with income tax, so we're only dealing with individuals, not companies. Corporate tax and corporate tax losses, that awaits us later in our studies. Now, back in Chapter 2, we saw how we would include on the income tax computation the tax-adjusted trading profit of an individual. The basis of assessment we learnt in the previous chapter, Chapter 6, as ongoing businesses will be assessed on a current year basis. Remember, that's CYB, that current year basis. If any of that is a problem to you, before you go back into this chapter and continue with this lecture, it'd be a good idea to remind yourself of what we had as our bases of assessment. That includes not just the ongoing business, where it was CYB. Let's just remind yourself of that. If, for example, a trader had produced accounts for the accounting year ended, shall we say, 31st of December 18, then using the CYB, current year basis of assessment, in which tax year would that tax-adjusted trading profit be assessed? What did CYB mean? Well, no, it's current year basis, but what does that mean? It means, of course, that we assess for any given tax year the tax-adjusted trading profit of the accounting year ended in the current tax year. Ended in the current tax year, hence CYB, current year basis. So all we have to do is look at that one date, the year-end date, ask ourselves, of course, the question, in which tax year does that end? Does it fall? Well, that falls, of course, in the 18-19, the 2018-2019 tax year. So we know that the tax-adjusted trading profit of that period would be assessed, would be included on the income tax computation for 18-19 tax year. What we also saw in the previous chapter, and will be relevant again in dealing with this chapter, is, of course, we are sometimes asked to deal with not just a normal ongoing business that has been trading and continues to trade, but one that is either a new business, a startup situation, or where we see a cessation of trading. So we deal with either opening year's assessments or closing year's assessments. Now, again, it is important to know those because some of what we do here is underpinned by understanding those bases of assessment. But up until now in this chapter, when in Chapter 4 we dealt with the adjustment of profit, it was an adjustment of profit, i.e. we started with the net profit as per the P&L account, and we adjusted it to make it acceptable for taxation purposes. So what did that involve us doing? Remember, it was an adjustment of profit, so we didn't start from scratch and produce an entirely new taxation P&L account. No, what we did, of course, was to adjust the accounting profit provided to us. And how did we do that? Well, an adjustment will mean either adding to the accounting profit or deducting from that accounting profit. It was a series of pluses and minuses, and of course maybe zeros. If, as is likely in an exam question, you are asked in a written question anyway, in section C to deal with an adjustment of profit exercise, then you have to deal with all items listed within the question, all items on the statement of profit or loss, and if they do not require an adjustment, then you specify that with a 0. But otherwise, any adjustment to that net profit figure will be a plus or a minus, an add back or a deduction. So we learnt that there were many expenses indeed that, though allowable for taxation purposes, might not be allowable for tax. The most obvious one, of course, was depreciation. Perfectly allowable for accounting purposes, not allowable for tax. But we discovered, of course, that in relation to this adjustment of profit exercise, this add back and deductions from accounting profit to get an adjusted trading profit for tax purposes, that in relation to depreciation, though it was disallowed, what did we replace it with? Well, that's what Chapter 5 was all about. That was the capital allowance system, whereby we all work according to the HMRC basis, their system of capital allowances, the system by which tax relief is given in relation to capital expenditure incurred. Of course, it has to be qualifying capital expenditure, on qualifying plant and machinery as defined. But you put those two things together, Chapter 4 and Chapter 5, you have a tax-adjusted trading profit. In Chapter 6, as we've just discussed, we then learned how we related any figure of tax-adjusted trading profit to a tax year in which that profit would be assessed. And whether that was normal CYB or starting opening year's rules or closing year's rules, there we were always able to establish an assessment for any given tax year, right from the very first tax year all the way through to the very final tax year. But of course now there's a very big difference. For now, having done the adjustment of profit, having computed and deducting capital allowances, what we end up with is not a tax-adjusted trading profit, but of course a tax-adjusted trading loss. Therefore, what do we do with that? Because again, it should be understood that if HMRC are going to assess us, as they will, on profits, then they must give us relief in relation to any losses that have been sustained by that business. So we'll be examining within this chapter the various loss reliefs that will be available to us. Now, the first thing we need to know is, when dealing with a loss, looking at the tax year in which the basis period of the loss is being assessed, what do we include on the income tax computation? Well, what we will include is not a negative, not a bracketed figure representing the loss made, but in fact a nil assessment. And that's the first thing that we see here in section 1.1. If the basis period for tax year has a trading loss, the trading profit assessment to include, because it's not a profit, it is now a loss, what we include is nil within the income tax computation. We never ever put a bracketed figure. That can never be a negative on the income tax computation. So any loss, whether £1 or thousands of pounds, it is a nil assessment. And what we must then separately do is, depending on the particular circumstances of the taxpayer and which tax year we are dealing with, establish what loss reliefs are available, and having identified which loss reliefs are available, select the best use, the most optimal use of that loss for the taxpayer. So the loss may be relieved according to the following rules. A repayment of income tax may result in some circumstances. As we will discover, if you are able to use the loss in this year, that would mean that any income tax that would have been payable for this year would not now become payable because you've removed the income by the use of the loss. That's one possibility, by the way. We'll discuss it in a moment. If, of course, you carry forward a loss to reduce profits of future tax years, that would mean that future tax years' taxable income figures would be lower, and that will save tax in the future. But also, and more immediately, as we'll discover very soon in this chapter, we may be able to carry a loss back to go against income of an earlier tax year. And if that is the case, then what will that allow us to do? If we are now able to reduce income of an earlier tax year, income upon which we have already paid income tax, but now the loss relieves against that income, that would reduce how much tax should have been payable for that tax year. So as we've already paid the original figure of tax, it will generate a tax repayment. As we'll discover, one of the important issues in trying to get the best use out of our losses is to gain relief the earliest available opportunity. A cash flow benefit would be available by being able to carry a loss back to an earlier tax year, getting a repayment of tax that we had already paid for that earlier year. That is, in cash flow terms, better than reducing the amount of income tax that would otherwise have been payable for the current tax year, and of course is much better than carrying forward a loss and reducing the income tax that would be payable in relation to those future tax years. So what are these various loss reliefs? Well, I've sort of given you a resume already there, but we'll see it in detail now in section 2. The resume being that We could use indeed a loss made by the taxpayer in relation to the current tax year in the current tax year. We could carry it back to an earlier tax year. We could carry it forward to a future tax year. The question is, in each of these tax years, though we may know the amount of loss that is available to be relieved, because we can do our adjustment of profits, we can do our capital allowances, we can establish what, therefore, in place of a tax-adjusted trading profit, is now the tax-adjusted trading loss. But, of course, in each of the tax years in which it may then be used, against what figure of income may we offset that loss? And that's going to be the critical but very basic issue that we'll deal with right from the very outset. So what are these reliefs available? Well, the ones relevant for us in relation to our syllabus, our main reliefs for a trading loss are as follows. A very simple one, but with no immediate benefit achieved, is to carry forward the loss against future trading profits of the same trade. Carry forward against future trading profits of the same trade. So if we do not choose to use that loss earlier, it will then, as we'll discover in this little note in section 3, automatically be carried forward to set off against, as we'll see here, may be carried forward to set against the first trading profits arising from, as we've already seen, the same trade. The trading loss that you carry forward must be set off in full. No partial claims are available against the next available trading profit if this option is chosen. So if you do choose to, or if there is no other relief available, so the only option is to carry forward this loss, or maybe the remainder of this loss after any other claims have already been made, then any loss that is carried forward has one future home. It will automatically be set against the next available future trading profit of the same trade. So it's very specific. It is only one thing in the future that this loss will go against, future trading profits of the same trade. If, of course, we're able to use some but not all of that loss in, say, the next year or the year after that, then any loss that still remains after such a use continues to be carried forward until further profits arise. It will automatically go against the next available future trading profits. And so long as that same trade continues, then that loss may be carried forward indefinitely. If the trade ceases, then that loss will lapse at that point in time. If we have not otherwise been able to use it, then on cessation, then there is no future same trade to carry it forward to. Any unused losses at that point in time will then sadly lapse. Okay, so a very simple relief, but probably not the first one we would choose to use because we have to wait around before we get any benefit from it. There's no immediate cash flow benefit to the individual. A more immediate relief is here in section 2b. Relief against total income. Now remember what I said a moment ago. The issue about these different loss reliefs is having got the amount of loss available to be relieved, knowing that we may relieve it in a current tax year, an earlier tax year, a future tax year, then in any of those tax years, against what figure of income will it go? Now, if we carry forward, it's very specific. It is future trading profits of the same trade. So that one and only figure on the income tax computation against which it may go, future trading profits. But now, relief against total income, again, remember, if you can't remember, go back and look at your pro forma income tax computation in chapter 2 there and see what total income is. It's pretty obvious. It's the summation of all of your earned and then unearned income prior to any deductions from that total income figure. So relief against total income of the current tax year and or the preceding tax year. So here there is choice. We can go against the total income of the current tax year, or the preceding tax year, or current and preceding tax year. So if you only want to make the claim in the current tax year, an option, as we'll discuss in a moment, that is very unlikely, but if you only wanted to claim in the current tax year, you could. If you only wanted to claim in the preceding tax year, you could. If you want to claim, if there's enough loss, of course, to be so used, in both those tax years, current and preceding, you can do that. And you will specify the order in which the claims are made, whether that's current year first and preceding tax year second, or whether it's firstly preceding tax year and then the current tax year. So we've got lots of flexibility about the application of that loss, but no flexibility again in terms of the use of that loss, as we'll discover in its detailed note. We'll come to that just a little bit later. It will again have no possibility of partial claim, just like with the carry forward, where it would automatically go against the next available future trading profit of the same trade. Then any use against total income in the current tax year and or the preceding tax year is again without any ability to make partial claims. You will offset all of the loss against all of the total income to the extent that there is such total income. Now what that will do is, as we've already mentioned, is to give a more immediate use of the loss. Obviously, as we've already said, using it against total income of the preceding tax year would generate a tax repayment of tax already paid in relation to that preceding tax year. Any use of the loss in the current tax year would mean that tax that would otherwise have to have been paid at a future point in time will now be eliminated or reduced, depending again on how much loss and how much total income there may be. So in cash flow terms, the carry back is better than the current, and each of those is better than the carry forward options. But the problem with this current and carry back claim, it's against total income and there are no partial claims. Now again, if you can't remember the pro forma computation, take a look back now at that pro forma computation and understand, therefore, that from our total or indeed net income, there would be a deduction of the personal allowance. And a personal allowance may be used within a tax year, but you use it or you lose it. If you have an unused personal allowance, then it will be wasted. So one problem that attaches to this particular set of claims against the total income, be it in the current tax year or be it in the preceding tax year, is if the loss is bigger than the total income, it will, if claimed, eliminate all of that total income and therefore waste your personal allowance. You would be using a loss, the benefit of which, if not used in that year, could at least be carried forward for use in a future year. You'd be choosing to use that loss rather than the personal allowance. Because if you waste the personal allowance, then you've lost it. So it would be far better, of course, to preserve the use of the loss and eliminate any total income by the deduction of your personal allowance. So then we have a problem as regards what may be the best application of this loss. But the rule is very simple. We can make claims against the total income of the current tax year and or the preceding tax year. No partial claims available. Whatever is the loss goes against your figure of total income. But you get to choose whether to make a claim in just the current year, just the preceding year, or if in both, which way round you would wish to have it. Now, before we go any further, I would ask you just to pause, and if you haven't already, have a little look back at that pro forma income tax computation at the beginning of Chapter 2, because you will see reference on there to loss reliefs. It hasn't been important until now. It's merely been a a by the by, an aside there that, oh yeah, if there were losses, this is where they're relieved. Now, I need you to look at those because that will inform the use of these losses within this chapter. So do that now, please. Okay, well, hopefully you have reminded yourself of this, the pro forma income tax computation, and picked up what I was referring to a moment ago. That is, there are 2 points on this pro forma computation where those trading loss reliefs may be involved and come into and reduce the income of any tax year. First of all, the most simple of the loss reliefs, this one at the top, any trading loss relief brought forward. Now, the first one we looked at was the ability to carry forward a trading loss and set it off against purely one thing, future trading profits of the same trade. So if you're involved in a Section C question that involves losses and you have to demonstrate the use of that loss, then you make very certain that in your answer you show any brought forward, any carried forward trading loss directly being deducted from the trading profit against which it may only be offset. We don't want to see those trading loss reliefs brought forward being offset down here along with the other trading loss reliefs. No, any trading loss brought forward is only going to be offset against the future trading profit of the same trade. So that up here is where it must feature. And of course, what it will do is potentially take out all of any future trading profit should that loss be bigger than that future trading profit. And so far as the trade concerns, as long as it's the same trade that continues, any unused losses will continue to be carried forward to offset against those future trading profits. So that's where your carry forward loss relief will apply. But as we were just discussing a few minutes back, we have a more immediate relief that goes against total income. And that relief will apply in either the current tax year or the preceding tax year. The current tax year, that being the year of loss. We had an example, did we not, again to illustrate the use of our, just show you, bases of assessment here, that if you had a year ended 31st of December 18, that would be assessed in 18-19, and if that was a loss figure, then you'd have a nil assessment for the 18-19 tax year. That would be the current tax year, meaning that these loss reliefs would be available to be offset against the total income of the current tax year, 18-19, and or against the total income of the preceding tax year. Well, obviously, if the current tax year is 18-19, then the preceding tax year must be 17-18. So it's a simple enough exercise to identify the tax years to which we refer. So, coming back to our pro forma, whether we are dealing with the application of this loss relief, or these loss reliefs, I should say, in either the current tax year or by carry back to the preceding tax year, it is here that that loss relief is applied, i.e. against total income. Now, although it's not very likely, other than maybe in a Section A objective testing question, if you did have some qualifying interest payments being made by the taxpayer, then those too are deductions from total income. But you'll see the order here, we do indeed deduct that qualifying interest first from total income, and only then bring in our trading loss reliefs. And that in fact works out to be a good order in which to use those deductions, but it is the trading loss reliefs, the current year and the preceding year claims, will be made after having deducted any such qualifying interest payments made. So we now know where those loss reliefs will show on our pro forma computation. Right, that said, let's just go back to our Chapter 7 and look at the theory behind, the wording, the narrative behind these loss reliefs against total income in the current and or preceding tax years. Now, there'll be little that is new to you here, given what I've already said, but let's just go through this. As we know, a trading loss may be relieved against total income, as I've just said, after any qualifying loan interest payments, though that is probably not likely in a written question, either in section C or the application with an OT question in section B, probably only a section A question, but that is the order. And it goes there, a trading loss against total income of the tax year of loss. We now know how to work out the tax year of loss. We'll see another example in a moment here. If we look at that now, a loss, for example, for the year ended 30th of June 18. Right, accounting year ended 30th of June 18. We've got a tax-adjusted trading loss now for that accounting period. When would that be assessed? Using CYB. When does that date end? It ends in the 18-19 tax year. That is your year of assessment. That is the current tax year. So the loss of that year may be relieved against total income of the current tax year, 18-19, the tax year of loss using our normal CYB basis, and or the preceding tax year, which must therefore be 17-18. As we know, the loss is computed on an accounting period basis, and of course we will then have to take the accounting profit or loss, adjust it for taxation purposes, and then whatever that accounting period is, here the year ended 30th of June 18, that accounting period is then assessed using your normal basis of assessment, which on a normal ongoing business is of course CYB. Now, if we choose to make this claim, then the relief against the total income is taken. The loss must be set off to the maximum possible extent. So we cannot make partial claims. The only, and in most circumstances, unlikely situation in which we would restrict the amount of loss set against that total income is where the cap applies, subject to a cap on income tax reliefs of this nature, and that's detailed in section C below. But that cap, as you will discover, says you will be using all of the loss against all of your total income, but made up of any and all of any trading profit for the tax year in question. Now that would only be, of course, in a preceding tax year claim. Remember, in the tax year of loss, the current tax year, the assessment is nil. Why? Because you have a loss-making period at its heart, at its basis, as its basis period there. So the only time you see a trading profit is in the preceding tax year. Trading profit plus then the cap on any other income is 50,000 minimum. It may be higher. We'll see the detail of that in section C below. So unless your losses exceed £50,000, you're not going to have to worry about this particular maximum, this cap issue. But we'll deal with it later. What we do know is it does go against total income, and subject to the application of that cap, if the loss is bigger than the total income, then all of the total income will be taken out by the use of the loss, which means there will be no net income remaining for you to use and deduct against that net income your personal allowance. So personal allowances, therefore, may be lost, as total income is before the deduction of the personal allowance. But as we've said, partial claims are not allowed. So you can't preserve the use of the personal allowance by making a partial claim in this the current tax year or preceding tax year reliefs. You can't do it. It's an all or nothing claim. A claim against total income may be made, as we know, for either the tax year of loss or the previous year, or both. 2 years are treated separately, and therefore a claim is required for each such year. Each year requires its own separate claim, and you will specify the order in which you make those claims there. Okay, that's all the theory. Let's now have a little look at an example that I've set up here for you. So if you now just pause and actually copy down the information here, what you'll see before you do pause here is that we're looking at 3 tax years in order: 1718, 1819 and 1920. And you will discover that critical information there, a nil assessment in relation to trading income. Why is it a nil assessment? Because, of course, whatever was the accounting year ended in that tax year 1819, the current tax year, that adjusted accounting figure gave you a tax-adjusted trading loss. Now, whether you started with a profit figure, whether you started with a loss figure and made it bigger via the adjustment of profits, doesn't matter, but you've ended up with a tax-adjusted trading loss. And whatever that figure may be, you do not show that as a bracketed figure here within your income tax computation for that tax year. Instead, it is a nil assessment. Thankfully, as you'll see from what we have here, is it's a one-off. That in the previous year, we were profitable, very profitable, £50,000 such tax-adjusted trading income. And in the next tax year, we're not as profitable, but we are still profitable, with a £26,000 tax-adjusted trading profit. And to make life more, shall we say, interesting, we've got some other sources of income here. We've got property income, and their BDI, that is bank deposit interest, i.e. savings income. We can see the numbers there. We've then left a space for you to include total income. Do not put those figures in as and when you now copy these numbers down. Leave that alone. Then you'll see that I have already left a gap up here after trading income and before listing the other income, and I've left another gap here after total income. So whenever you're dealing with loss reliefs in an income tax computation, just automatically do this. If you're dealing with a Section C pro forma, or even if you're doing your own little working to back up your answer to an objective testing question. Leave a gap after trading income, leave a gap after total income. Why? Because if any part of a loss is carried forward, there is your current tax year, your tax year of loss. So if it's carried forward, that is where any trading loss carried forward would be deducted against future trading profits of the same trade. If, of course, you want to use that loss in the current tax year and or the preceding tax year, then you would see the claims going in here for the current tax year, here for the preceding tax year. Your current and or preceding tax year claims against total income. So leave space for those reliefs to go in. We would then, from any revised figure of total income, i.e. then net income after the deduction of that loss relief, after any such claims there, we would then, from net income, be deducting the personal allowance. Now, we know that for the 1819 tax year, it's 11,850. What any question would do where it asks you to deal with other than just the current tax year, and it is going to ask you to deal with, I think, other tax years than just the current tax year, they'll tell you just to assume that the current 1819 tax year's personal allowance is relevant in all tax years. So I put those deductions in, ready to go against any net income figure that we get, to bring you down to the taxable income figure. So I'd like you, please, to copy out that information, if you would be so kind. Again, you know what the personal allowance figures are, so I can just take those off screen for the moment to give you that information there. So if you'd be so kind as to copy that information down as it is there, where our trading profit figures have gone in, where there's a loss it is a nil assessment, property income and bank deposit interest, again taken straight from the question, include those. Identify then total income down here, get that total income figure, And then away from that total income, we would then be able to deduct any of the current and preceding year reliefs. So if you would do that now, please, and then rejoin us. Okay, well, hopefully you've got now recorded, as we see and have seen before, the figures of income and, of course, where there is a loss, this nil assessment in 1819. But the figures of income, trading income first of all, then a gap. You'll see now, don't you bother to write this in just at the moment, but that's where any brought forward, any carried forward relief will be applied, as we know, directly against and only against future trading profits of the same trade. We've listed out as given the property income and bank deposit interest. That will give us, though we have not yet recorded the total income figures, but away from that total income, we would then be able to deduct either current year relief and or preceding tax year relief by carrying back to that preceding tax year. When we take those reliefs away from total income, it gives us net income, from which we already know we will be deducting our personal allowance, which was said, you'll be told to assume, is the standard 1819 tax year personal allowance figure of 11,850 to use across the board for all relevant tax years. Once it is deducted, it will bring us down to taxable income. Right, so what are those options as we've witnessed so far? Well, the first of the options we identified was simply to carry forward. Now, of course, what we don't yet know is what figure of loss lies behind that nil assessment. Now, of course, you will be given that figure within a question. You may possibly, in a much bigger written question in section C, a 15-mark income tax question there, have to work that out for yourself by doing the adjustment of profits, by doing the capital allowances. And of course, you discover that at the end of that, instead of a tax-adjusted trading profit, you've ended up with a tax-adjusted trading loss. That's a nil assessment. Now, of course, you would have had to have known which tax year to relate that accounting period to, in terms of the bases of assessment. Now, as you can see, it's an ongoing, continuing business. We'd be using CYB. So if now I told you that this particular individual has always prepared accounts to a year end the 31st of December in each year, then which year ended 31st of December would be assessed in this, the 1819 tax year? Hopefully it takes you nothing more than a nanosecond to know that if we prepared accounts to 31st December each year, we're looking for the 1819 tax year, then that particular, let's get it here, year end, would be the year end 31st of December 18. And I'll now tell you that the missing figure, the loss figure, is 32,000. And I've set this up in what we're going to call here working one, our loss memorandum, our loss memo column. What we'll be able to do is to identify each relief as we have applied it, not just on the face of the computations that we've prepared for each of the 3 tax years involved here, but also in this single working, a loss memorandum. We'll develop that and show it together in a moment's time. Let's have a little look at what the options are, because again, what you may get here is both what is essentially, of course, a computational exercise, but also a narrative, a discursive exercise of identifying, first of all, what reliefs are available, and then selecting from the available loss reliefs what you think would be the best options to use, and giving reasons as to your choice. Why is that the best option that you are suggesting? Okay, well, the options are, as we know, firstly, this one, the carry forward relief. Now, if we carried forward, remember our loss was £32,000. Do not bother to write this in, but what you would do if you carried it forward would, of course, be to simply go 26,000 loss being used. You had a loss of £32,000 to carry forward. It goes automatically against the next available future trading profit. That is 26,000. 32 is big enough to cover all of that profit, hence you would use all of it. Now that would then be recorded here in your loss memo, saying that the carry forward relief in 1920 tax year would have used 26 of that £32,000 there, and that would leave £6,000 that would of course then continue to be carried forward against the next available future trading profit, which presumably, so long as profits continue to be made, going forward from 1920 tax year, would take you into the 2021 tax year. So there would be one option. And again, we could identify that in narrative form and state what would be done with it. Now, of course, what it would mean is there's no immediate relief for the loss. We're going to have to wait until the tax would have been payable for the 1920 tax year, and then for the remaining £6,000 of loss to carry forward to the 2021 tax year for it to be relieved. What we can also see here, that in using that particular loss on the carry forward basis, it would end up wasting some, not very much, but some of your personal allowance. How come? Well, if I've removed all of that 26,000, pardon me, which I have, then I'm left only as total income, the property income, and the bank deposit interest. Again, do excuse me. So £9,000. So £9,000 would become the net income. Again, don't bother to write this in, just watch there and, watch, listen and learn. That would leave 9,000 as net income. The personal allowance is 11,850. So I've wasted some of that personal allowance. So some of the loss that I have used is taking out profit income that would not have been taxed anyway, because it would have been covered by that extra personal allowance. 11,850, there's only £9,000 of income remaining against which to offset it. The loss that would be used, of course, had we left the profit in 26,000 plus 9, that would be 35,000, less your personal allowance of 11,850. Think about your income tax rates and your various band limits, and we know that all of the loss being used, 26,000, is either saving tax at 20%, the basic rate. We are only a basic rate taxpayer, and some of that loss used is saving no tax at all, because it's dropped this figure of income below the personal allowance level of 11,850. So some of that loss is saving no tax at all. So although it is an option, by comparison to what is available elsewhere, it's not a very good option to pursue. So what other reliefs are there? Well, of course, the other reliefs are these: the current year and carry back relief against total income. Well, in the current year, the total income is 9,000. And let's just remove the carry forward option for a moment. We dealt with that. We've seen it's a possibility, but it's not going to be a particularly good use of that loss. Now then, the other options, set off against total income of the current tax year. Well, you tell me, do you really think that that current year claim is of any use whatsoever? Look at what the current situation is. We have total income of 9,000 prior to any loss relief applying. We have a personal allowance of 11,850. What is the current taxable income? It is nil. So there is absolutely no way that you are going to use this current year relief and remove that £9,000 of income. You would be wasting that loss relief, because that income, 9,000, becoming net income 9,000, is already covered, as we've seen, by the personal allowance. Any use of the loss in this, the current tax year, would save nothing. You are wasting the personal allowance, so you're not going to do it. So that, therefore, will be left as it is. Thankfully, the claims that we're talking about against total income are to set off against the total income of the current tax year and or the preceding tax year. So we don't have to make any claims against this £9,000, and we won't. What we can do instead, because there are far richer pickings to be had in the preceding tax year, 1718, is in that year we have a total income of £60,000, and that means that at the moment, prior to any loss relief applying, 60,000 income, 11,850 personal allowance. Your taxable income in here is currently just a little bit over 48,000. Now you know that the basic rate band limit ends at £34,500, and you then go into higher rate tax. You move from a 20% tax rate to a 40% tax rate. So what this relief would now apply and allow you to do, so now we won't apply current year, we will apply the carryback relief. How much loss did we have? £32,000 of loss. Now there is no partial claim. We don't want it anyway. We will use all of that loss in the current year. That will bring your total income of 60 reduced by 32 down to a net income of 28. More than sufficient to cover that personal allowance, and that therefore would bring your taxable income down to, what's that? If that was 12 away from 28, it would be 16, so £16,150. So that £32,000, you could evaluate it if you needed to, would have saved tax to begin with in bringing your taxable income down to $34,500 from what it would otherwise have been. You've saved tax at 40%. Then anything that reduces it from $34,500 down to your bottom line $16,150, that will save tax at 20%. So none of the loss is wasted, as it would have been with either of the other two reliefs, the carry forward claim or the current period claim. Now none of it is wasted, and the loss that is being used is gaining relief at least partially at 40%. The tax saving from using the carryback claim to the preceding tax year is going to be hugely more beneficial. A combination, as we've said, of tax saving at 40% and 20%, as compared to either no tax saving in the current tax year or limited tax saving and only at 20% with a carry forward claim. Plus, if you make this claim for the preceding tax year, remember the cash flow advantage of that as well. What does it do? It allows last year's income, taxable income figure to be reduced. We will already have paid the tax for last tax year by the time we do our income tax computation for the current tax year. So it will generate a repayment of the tax paid, some at least, most of indeed the tax paid for the preceding tax year. When dealing with an exam question, be careful, of course, to answer only what they've asked you to do. If here they've merely asked you to identify all of the available options, we've done that from the simple carry forward to the current year claim to then the carryback claim. To having identified all of the possible claims, identify which is the best, clearly the carryback claim to the preceding tax year, state why it is the best, we are not wasting any of the loss, and some of that loss is removing income that has been taxed at 40% rather than merely basic rate of 20%. So the tax saving that is achieved is the highest, and to top all that off, it is immediate, because immediately the claim is made, it will reduce the income of the preceding year. We've already paid the tax for the previous year. This will generate a tax repayment. There'll be a cheque coming to us back in the post from HMRC. We will get our repayment made directly to us. This is as good as it gets in terms of our loss. In terms of the loss memo, all you'd have had to have shown here under this option is all of that £32,000 there being used via what was the carryback claim to which tax year? It was the 17-18 tax year. All of it used, no more loss remains. Thank you very much, job done. Right. What I'd like you to do, therefore, before our next session on this chapter, when we deal with the carry-on from here, a few little issues still on the current and preceding year loss relief claims, before then investigating rather more specialist loss reliefs that still await us in this chapter. But check through the exercise that we've just done, please. Play that back to yourself if needs be. And then in relation to your notes, you have got a very simple example 1, testing the carry forward of losses. We've already seen section 4 and how we claim losses in the current and preceding tax year, and then we've got example 2. Again, calculate Charles's taxable income for each relevant tax year, assuming that the trading loss is used in the most beneficial way, and trading losses will continue for the next few years. You've got to identify what the options, of course, are, and then identify what we think will be the best claim. Also assume that the personal allowance for 18-19 applies in all tax years. Again, remember the setup as we showed it. We will do a columnar working where each of the tax years has its own column. What have we got here? Year ended December 17, using CYB. That is 17-18. December 18 is 18-19. December 19 is the 19-20 tax year. There, this time, are the 3 tax years that you need to identify what the figures of taxable income will be after you've claimed relief in the most optimal way. So work, please, through those 2 exercises. Ensure you thoroughly review through the answers to them. And next time, we'll continue with just this current and preceding year claim and what we mentioned earlier, and what you'll see here creeping in terms of note C, a cap that may apply. Once that is done, we then move to the rather more, as I'll call them, specialist loss reliefs. But what they are, well, that awaits us again in our next lecture, indeed next lectures together, so far as this chapter is concerned.